Welcome to Morningstar. I'm Larissa Fernand, and with me today is Anand Radhakrishnan, the Chief Investment Officer for Equity at Franklin Templeton Asset Management India. This is part of a series where we go beyond the numbers and look at the mindset of seasoned money managers. Anand, thank you for joining me, and it's great to have you here.
Thanks, Larissa, for having me on this show.
So, Anand, my first question is that you have seen a lot. You've seen bear markets, you've seen bull runs, you've seen your funds do well, then do really badly. You've seen your AMCs go through ups and downs. So how has this changed your investing psyche? How has it impacted you over the years? How have you evolved as an investor?
So markets generally don't stay in a linear direction all the time. They kind of move on a roller coaster kind of ride, whether you like it or not. And this leads to periodic highs and lows, not only of market levels, but also investors' moods and sentiments. If you want to kind of, travel this journey fairly well, we need to at least partially mute these highs and lows that happen with this ride. Only then we can kind of survive these cycles. To say it in some other words, it is not being excessively euphoric during good times or wallow in despair in bad times is very important characteristic of a good investor. A good fund manager has to be bestowed with this characteristic, either by nature or should consciously develop this ability. Or in some sense, I would say some kind of an equanimity is very much is required for one to handle the highs and lows of the market. So one way to kind of develop this equanimity is to have some sense of skepticism. I won't say excessive skepticism, a moderate skepticism to kind of question things, whether it is good or excessively optimistic thing or pessimistic thing. If you can question the reasons for that, that trait can help one to kind of handle the roller coaster ride fairly well. So I would say try to develop equanimity and a healthy dose of skepticism is, I think, a trait which is very important. Skepticism helps one to, avoid the risk of ruin. And you don't lose a lot of money if you are slightly doubtful. Now, so very early in your career, I was lucky to have a coach or a boss who kind of helped me to develop this attitude of questioning things, challenge the assumptions, and not getting swayed by the tide or excessively go with the flow kind of a thing. The only flip side of being skeptic is that you miss some good opportunities, good ideas. And I think I have had my share of big misses. Fairly simple ideas, straightforward, which would look clear to a naked eye. If you kind of start to doubt or question it, you tend to miss that good idea. I think that is the flip side of having skepticism. So you got to weigh the pros and cons of having developing this quality and to arrive at some balance which works for you. I think that is what helps one to take the good as well as the bad cycles of the market fairly well.
How did you feel when you missed those bets?
Obviously, you feel bad about it, and you want to if you want to go back and correct it a little bit, and change things, etc. So there are times where you need to consciously mute down this skepticism. Yeah, some people naturally are more exuberantly optimistic, and they don't have the problem of missing the ideas. In fact, they may catch once in a while very bad ideas as well because of this optimism. But I think this the regret that comes out of missing a good idea is you have to again develop a consciously an ability to mute down the skepticism, which again comes out of rigorous analysis and I think thinking. You can't escape that particular kind of workout if I may say so, to kind of avoid making big misses.
Were you very optimistic or were you a skeptic when you started off?
I used to be a kind of very optimistic person when we started when I started my career in 1994. The economy was doing pretty well. There were coming off liberalization era, and there was a huge optimism ahead of us. But very strangely, next 5 years were one of the toughest period of the market between 1994 to 1995, which is some kind of a baptism by fire for us, in the sense that with all our bullishness, positivism coming out of B school and trying to change the way investment management is done in this country and all that kind of stuff, and suddenly you're kind of brought down to reality where you are trying to wonder, economy is supposed to be doing well, why is market not doing that well, kind of a thing. So there was a period where you need to constantly kind of tone down or readjust yourself to the reality of the markets and be a little more realistic.
You know, you passed a comment recently, which I really, really liked. You said a good track record doesn't happen by accident. So what are the traits you felt helped you deliver this good track record?
So like in any other profession, excellence and longevity in investment profession doesn't happen out of accident. It doesn't happen. It's not happenstance or coincidence that a fund manager or a fund house has a good long track record. And these are outcome of years of doing things in a systematic manner. More importantly, it is not easy to have good track record without meaningful shifts in styles. That is, at one part of career, you would follow a particular style and then you change and then you dramatically go to the other end, etc. And those are very confusing for people to understand why you are doing it. I think very early in your career, it's very important to develop a particular consistent style, which is irrespective of the size of the money you manage. There were times where I was managing hardly 20 crores of AUM in a particular fund. And my supervisor, my boss used to tell me, imagine you are managing 2000 crore and act like that. You cannot adopt a particular style which is suitable for a very small fund high size and then show performance and then collect big money and then totally do different things. Then you are not going to have a consistent track record. So very important element of having a consistent track record is having certain style, which is by and large stable and constant. This doesn't mean you don't learn. This doesn't mean you don't incorporate the learnings of the market into your style. But this basically means you don't swing from one extreme kind of approach to investing to another extreme kind of approach to investing. I think that is very, very important. And very early, second thing is very early on, you have to board a learning curve. That is, you have to assume you are riding a learning curve first. You cannot start with an assumption that I know how to make good investments. You have to start with an assumption that I am trying to learn how to make good investments, and I will keep learning and I will keep making and tweaking, just adjusting myself towards changing realities. So generally, I would say that open-mindedness and learnability is very, very important to maintain, to have a good track record over a period of time.
So you spoke of your style, how the style must stay consistent. Is there anything you would do differently today that you would not have done or would do differently 2 decades ago?
I mean, I used to maintain diligently lots of records of my investment decisions, key meetings, learnings from corporate meetings, market cycle, my own understanding of market cycle for the first 10, 12 years of my career. But after some time, I started relying more on my memory and less on written notes or diary, if I may say so. If I do one thing differently, is that I would have continued to keep a diary of my good decisions, bad decisions, mediocre decisions, etc. Because now I totally operate out of memory, especially last 10, 12 years. Whereas in the first decade or so, I used to exactly know when I took a decision or when I made a mistake and why I made that mistake, etc. I think that is one I would like to do slightly differently than what I have done. Second, like I said early, that there are times where I would say bit of caution or being a little bit conservative in your investment decisions. I have kind of let go of meaningful opportunities, which could have even added a few more percentage points to investors' returns over a period of time. So I would like to change that as well.
When you second guess some of your stock picks, how much does gut feel come into play?
I am not at all a gut person, to be honest. I am a numbers person. I excessively rely on analytical inputs, rational points, etc. But yeah, certain businesses kind of sound right. Certain businesses, you don't have to break your head to know that this is a good business to get invested in, kind of a thing. So you need to have that understanding that that a good investment decision, while numbers can help you, etc., you need to have a very good feeling about it when you are investing in that company. Now, ultimately, the outcome of an investment decision is it's only a probabilistic. It's not very deterministic in the sense we don't know upfront whether this is going to make good returns or not. But you do think that these 5, 10 variables put together seem to be a good recipe for success, going by the past experiences, what others have done, etc. And you say that, okay, this seemed to be a possible winning candidate. But having said that, once the decision is taken, there are multitude of other possibilities which can happen as well. Regulations can change, competitions can change. So many things will happen which will derail your hypothesis. I think those are the times where I would say you gut no longer works. Then you got to go back to the drawing board and you should kind of rework your assumptions. Ideally, I would say you need a good sounding board, someone with whom you can go and brainstorm the particular situation or an event or an idea and seek the feedback instead of getting caught up in our own mind's echo chambers and keep kind of dwelling on the same idea, though the reality would have changed. I think you need to have a good sounding board, and that's where the advantage of working in a team of good investment professionals helps.
In your all the decades that you've been managing money, what has given you sleepless nights?
Couple of things have given me sleepless nights. I think when the management does something which you have not budgeted for, something which is totally sounding wrong or odd, etc., or not in consonance with the way you have formulated your hypothesis or your thesis around an idea, then you start getting worked up. Then sometimes you fight with the management, or you get into a lengthy argument with them, etc. And those are not very pleasant conversations. More often than not, it leads to you changing the opinion or view about that. But sometimes changing the view is easy, but changing the investment is tougher because it takes a lot more time and effort to move out of an investment, especially when your investment thesis gets changed. So I think a poor governance or a string of bad decision making by management has given me reasonable trouble in the past.
As a fund manager, your private portfolio, you can't have a free hand with it. There are too many regulations involved. What if you had to, let's say you quit your job and now you have a completely free hand to manage your personal money as you deem fit? What would be your asset allocation like? Where would you invest? Would you
Okay,
go
more than a specific asset allocation, I'll say that I'll get more disciplined about my own investments and I get my own time, because I haven't sweated my savings as much I would have liked to sweat it. I go through this phase of lazy accumulation of savings, and then suddenly get inspired and go and invest a lump sum kind of a thing. So, which is contrary to what I preach to people, where I say that, do systematic investment planning, etc., etc. When it comes to personal thing, I am at fault of not following it as well. So one thing I would do is to be more disciplined and kind of more structured and periodical about my investments rather than being sporadic and ad hoc kind of a thing. Second thing is, I think in terms of allocation, I wouldn't change. I'm generally more risk taking in my portfolio, because I think that if the part of the savings or investments which have earmarked for my retired living, or even for my kids for that matter, I don't need to be very conservative about it. I can take meaningful risks and kind of take the volatility along with it, etc., because my time horizon is long. So I think those part would be definitely be in equities or similar risk kind of an assets. I think what is the safety net kind of a nest egg which is required for the bare minimum you need to lead a healthy lifestyle for a reasonable force. This thing, that is where you kind of keep it in fixed income or low risk assets. I mean, as you probably age, it is 30-70 kind of number. If I have to put a number to it, 30% in safe, low risk assets, and 70 in better yielding, slightly more volatile assets.
Okay. And my last question to you is one that I normally would not like somebody asking me because it's so cliched. So if you had to take one learning from all your decades of experience and tell a very young asset manager, or tell yourself starting out, what would it be?
And don't start with a definitive view about investments. Don't say that I like this philosophy of making money. You never know till you make serious money. So what works for you is different from what works for somebody else. So I would say be open-minded, have a very open-minded approach to investing, and kind of gravitate towards a style or a mix of styles which suits you personally or your firm, whatever you represent personally. I think that is most important. It's very easy to get carried away by catchy books, sloganeering, or a branded form of investments. I would put it that way. But it's very tough to have your own grounding on where you feel most comfortable about making a particular investment. I think every young professional need to feel comfortable about that path, about the kind of path which they are choosing in making their own investments or the client's money, investments of the client's money. You should not do something which makes you feel totally uncomfortable kind of a thing. I think that is probably the single most thing I will tell the youngsters.
Ah, that's lovely. Thanks so much, Anand. It was fantastic chatting with you. Thank you for your time. This is Larissa for Morningstar. Thank you for watching.